Welcome to week number 6. We are past the halfway point in our course, and we are going to be covering Mod 8, which is on shareholders' equity. The comic strip on this chapter is, "That concludes my prepared remarks. I will now evade your questions." It sure sounds like that all the time when we hear CEOs talking about their company, because they really have a lot to protect and not a lot to gain by disclosing too much to the public. The learning objectives here are many. There are 8 of them, but many of them are specific on the types of accounts and transactions that occur in this area of equity. So the first we'll look at the stock features, and these are some of the terminology and buzzwords that you need to know when you're looking at equity. The second through the 7th are examples of specific types of transactions where we'll be looking at why we need to do certain things for the company's equity and how do we record them. LO2 is on stock issuance. LO3 is on stock-based compensation, which could be warrants, restricted stock rights, or options. LO4 are cash dividends. LO5 are stock splits and stock dividends. LO6 are accumulated other comprehensive income, abbreviated AOCI. LO7, learning objective 7, are convertible securities, and these could be bonds or preferred stock. And finally, LO8, learning objective 8, is earnings per share, looking at both primary and diluted. So when we look at equity, this chapter breaks it into 2 general areas. On the left side, you see contributed capital, which are money that came in from the outside. So within this, we have some stock basics, the definitional items I was referring to. Then book value, which is looking at the total stockholders' equity divided by the outstanding shares. Market value is the price per share in the open markets. Third is statement of equity, and this is one of the 4 basic financial statements. Next are the 2 types of stock most commonly found, preferred and common shares. Then some specifics like what happens when we issue stock, then what happens when we repurchase our own stock, and finally, what if we use stock as a means of compensation to our employees. So those all relate to the outside perspective, or kind of money coming in, if you will, to the company. The right side is earned capital, and these are items where the company has made profit or otherwise doing some things internal to the company and its retention of profit. Cash dividends and stock dividends, these are giving back some value to the shareholders in cash or in additional shares. Stock splits is a bigger form of a stock dividend where we give, like, for every share you own, here's 2, right? That's a stock split. We'll explain why we do that later on in this chapter. Then AOCI, which is kind of a back door into the balance sheet, and we'll talk about what I mean by the back door. Convertible securities, these are where you can change from one type of security to another. Most commonly, it would be convertible bonds to common equity or preferred stock to common equity. And finally, earnings per share. So let's start with some basics, and there's going to be a lot of terminology and buzzwords here, but they're important to know because they have meaningful differences, even though they may sound the same. First, there are classes of stock. The broad types of stock would be preferred and common, common being the one that you need definitely to start a company. Preferred has a different set of rights than common, and therefore they're called preferred, and those rights are called preferences. Surprise, surprise. And those give preferred shareholders a little bit of an edge on certain conditions that common shareholders do not get. Also, within common shares, there could be classes. So there could be Class A common, Class B commons. Although you only need one class of stock to start, namely common, many companies have more than one class or more than one type of stock. The second is authorized shares. And authorized shares often confuses students because it seems like it should be very quantified and rigorously determined, but it's not. It's a legal number that is put into our shareholder agreements and our articles of incorporation when we go to the Secretary of State to register our corporation. It represents the maximum number of shares that may be issued by the company, but it's not a final number. If the company wants to change it, it can do some board resolutions, shareholder resolutions, and refile with the state. So it's really an administrative or legal term more than anything else. So authorized is simply the maximum that is currently allowed given its registration with the Secretary of State and the agreement with its shareholders. Next is shares issued. So the term issued is as it sounds. It's shares that were passed out to outside investors in exchange for money to finance the company. Often tied to this would be another value called par value. Par, again, is one of these legal things. It's what is filed with the Secretary of State, along with the same paperwork I just described earlier. And typically par is something easy, like $1 a share or a penny a share. It's even possible to have no par stock. Again, this is more of a legal detail than anything that is financial in nature. Treasury shares are stock that you bought back. The company sells stock to outside investors, and due to excess cash or other circumstances, the company wants to buy back some stock, it can do so. And when it does so, it's called treasury shares. We pay money out, we buy back our own stock, and it's like putting those stock certificates in a safe in the treasury. And finally, outstanding shares. Outstanding shares means the shares that are out there, right? So the word out is relevant here. These are the total issued shares, which are the ones that you ever issued, minus the amounts that's sitting in your treasury. Outstanding shares is simply total issued shares minus the treasury shares. Now, if we look below, we see examples for Johnson & Johnson. They have preferred stock authorized, but notice on the right, they're zeros. Although they have authorized shares of 2 million shares, they have not yet issued it. The company may do that because they may want to issue it with less time frame involved, so they may go ahead and set this up and not actually issue it until they need to do so. The second is common share. Here we see the par value of $1, authorized at 4.3 billion shares, and issued of 3.1 billion shares. Authorized as legal maximum. Again, they can change that with a filing and approval by its shareholders. And the amount that's actually out there, which is an important number, is 3.1 billion shares. Next is accumulated other comprehensive income, and we'll talk about this more specifically. Retained earnings, this is the amount of money ever made by the company minus all the dividends ever paid by the company. We've talked about this from probably week 1 of our course. Retained means kept, earnings means net income. So it's the amount of kept net income. It's net income minus dividend cumulatively since the beginning of the corporation. Bottom portion talks about treasury stock. It's subtracting the treasury shares, and in this case, the company has bought back 360 million shares, and it's sitting in treasury. Now we have total shareholders' equity and total liabilities and equity, which must, of course, equal assets. So these are the 5 basic things you see on the face of your statement of shareholders' equity and what the words mean. At the bottom now, we'll see some common metrics that we use later on in this particular chapter, and also very important numbers for the stock market to get their arms around. The terms are outstanding shares. On the very bottom, you see outstanding shares equals issued shares minus treasury. In this particular case, Johnson & Johnson has 3.1 billion shares minus the treasury of 364 million, and that leads to total outstanding shares of 2,755,000, and we'll use this later when we do computations of earnings per share. But this is something that we can derive right from the face of this particular shareholder equity section of the balance sheet. The next set of basics relate to the earned capital, and there are 2 parts of this. One is retained earnings, and the other is AOCI. So retained earnings is, as we mentioned, earnings kept in the company's cumulative net income minus dividends, and AOCI are the 4 items that we'll see in a moment, and these bypass the income statement. So think of an expense, then instead of being recorded as an expense, which reduces net income and therefore then ties into retained earnings, that's the path we've used throughout this course. Instead of going through that route of the income statement, imagine that an expense or profit, a gain or loss could somehow sneak past the net income and go right to equity directly. And as odd as that sounds, that's exactly what happens with this category called comprehensive income. AOCI is a very technical area, and we'll look at them and explain a little bit on why GAAP requires and allows some gains, losses, profits, and losses to flow around the income statement and go right to equity. There are reasons, of course. Start with some commonly confused terms of book value versus market value. Book value, the word book means it's in the general ledger or the accounting records. So book value refers to the total amount of shareholders' equity, in this case, excluding preferred stock, because it's only common equity we look at. And the formula is on the very bottom of what is book value per share. Shareholders' equity minus preferred stock, that's book value of common shareholders. And if we divide that by the number of common shares outstanding, we will get a dollars per share of the book value. That is book value per share. On the right side is market value. Market refers to outside, determined daily or by the minute when the markets are open. And this is determined by trading. The traders, the buyers and sellers of a particular common stock, will determine the price, and that price is the market price per share. And there's a related topic called market cap or market capitalization, which equals the total outstanding shares, there's that number again, times the price per share. And that's a quick measure of what the company is worth. When you look at the total shares outstanding times the dollars per share equals the total dollar worth of equity at the market price. Next, we'll look at the statement of stockholders' equity, one of the 4 statements, of course. And this is simply a reconciliation from the beginning of the year to the end of the year of what happened in the relevant accounts in equity. And if there are more than 1 years presented, which there would be, it would show for all the periods presented what happened in the equity accounts for those reported periods. In this particular case for J&J, we have 2014 December going to January 2016. Notice that even though the increment looks like 2 years, it is just a little over 1 year movement. We have the balances for retained earnings, AOCI, common stock, and treasury. And it simply explains all the things that happen during the year to these 4 accounts. Net earnings is simply increasing retained earnings. Second is cash dividend paid, which simply reduces retained earnings. Third is employee stock option plan, and also a issuance of some treasury stock. Next, we have repurchase of common shares, and this is where we take out common shares from common stock and we pay for it with cash, and it goes into treasury. Other, that's disclosed in the notes to the financials, and OCI, which is one of the 4, one or more of the 4 exceptions to going through the income statement, is the $2.4 billion, right? So at the very bottom, we have the balances for the 4 components of shareholders' equity, those being retained earnings, AOCI, common stock, and treasury stock. There's a note here that the employee stock options and compensation are shown as a reduction because we're using some of the treasury shares to satisfy that particular transaction. The book value per share, we can look at the number above. That's $71 billion. And if you divide that by the outstanding shares, that handy number we've used already a couple times, we get $25.83 per share. If we look at the market price as of December 31st, it was 102, so it's quadruple the amount of book value. Book value is not a measure of market value and does not purport to do so. And finally, market cap is taking the price per share times the outstanding shares. In this case, we end up with $282 billion. And notice the 282 compares to 71. Again, the book value is not reflective of the market value of the company. It is simply the accounting number. Big difference between book and market. Preferred stock have preferences, and they're not common. And what are some of the more typical preferences? First is dividends. Preferred shares often have a dividend that is intended to be paid. And this is per share per year. And it is intended because unlike a loan from the bank where you have no choice, you must pay or you're in default, in a preferred stock, the intention is to pay it. If you don't pay it, it's no legal obligation to do so. The company cannot be sued by its preferred shareholders to make those payments. However, if you don't pay a preferred stock for a given year, that amount that's not paid is carried forward to the future. It's kind of like owed to the people. Again, it's not a legal obligation, but it will be made up by some subsequent payment, and it's not just forgotten. Second are liquidation preferences, and this just means that preferred shareholders get paid prior to common shareholders in the event of a liquidation, and that could be a bad news event like a bankruptcy or a good news event like you got bought out by a suitor. Third are conversion privileges. This allows the holder of the preferred shares to convert from preferred stock to common stock at a pre-specified ratio of how many common shares do you get for every share of preferred you have. Those are common provisions for preferred stock. Next, we'll look at an example of Dow Chemical. Since they have preferred stock, you'll recall J&J has authorized them but never issued them. Dow has in their preferred stock section, they have Series A preferred, and it's a $1 par, $1,000 liquidation preference, and 4 million shares. And the disclosure gives the details of this particular class of stock, and it is that they will pay a dividend. How much? 8.5% of par value, and par value is $1, so it will pay 8.5 cents per dollar par value. If we have $340 million, that represents the 4 million shares outstanding times the 0.085 shares, and that's what it represents, right? That's the dividend, is $340 million per year. Secondly, they're convertible, and the conversion ratio from preferred to common is given at 4.2010, or 24 shares of common for every share of preferred. If the holder of the preferred shares meets the obligations or meets the requirements and chooses to convert. Non-controlling interest. We've seen this before in consolidation. It's where a company owns most of the subsidiary, over 50%, however, not 100%. And on the balance sheet, we reflect that some of the assets are not belonging to the corporation, and these are called non-controlling interests. These exist both on the balance sheet for the amount of claims or value that is ascribed to the non-controlling interest. It's also shown on the income statement as the amount of the net profit that does not belong to the consolidated company. Non-controlling interest shows up in both the balance sheet and the income statement.